The crucial role of financial audits in corporate governance in today's complex business environment. Financial audits serve as vital safeguards against fraud, mismanagement, and regulatory non-compliance. For accountants and finance professionals, understanding the nuances of audit processes is essential for maintaining organizational integrity. Audits provide an independent evaluation that ensures transparency in financial reporting while offering stakeholders confidence in corporate decisions. This article explores key aspects of financial auditing from preparation through execution. Understanding the purpose and scope of financial audits at its core, a financial audit aims to verify the accuracy and completeness of an organization's financial records. It goes beyond simple bookkeeping by examining internal controls and compliance standards. Professional auditors assess whether financial statements present a true and fair view according to established accounting principles. Their work helps identify discrepancies before they escalate into larger issues. There are two primary types of audits: external audits conducted by third-party firms and internal audits performed within organizations. Each serves distinct but complementary roles in risk management. External audits typically involve certified public accountants who issue formal opinions on financial statements. Internal audits focus more on process improvements and operational efficiency. Compliance verification ensures adherence to tax laws, regulations, and industry-specific guidelines. Risk assessment identifies vulnerabilities in financial systems and control mechanisms. Fraud detection reveals irregularities that might indicate potential embezzlement or manipulation. Ethical considerations in conducting audits. Maintaining professional ethics is paramount when performing financial audits. Auditors must remain impartial and avoid conflicts of interest at all times. Confidentiality agreements protect sensitive information obtained during audit procedures. Breaching these could lead to legal consequences and damage reputational standing. Independence is crucial for ensuring objective assessments. Auditing firms cannot have financial ties to the entities they evaluate. Continuing education requirements help auditors stay updated on evolving accounting standards and regulatory changes affecting their profession. Preparing for a comprehensive financial audit. Effective audit preparation begins well in advance of scheduled reviews. Organizations should maintain accurate documentation throughout the year. Establishing clear policies regarding expense tracking, invoice validation, and asset registration streamlines the audit process significantly. Internal staff training programs ensure employees understand what constitutes proper record keeping and how to handle auditor inquiries appropriately. Implementing digital accounting software enhances data accessibility while reducing human error possibilities during audits. Data organization. Centralized storage solutions make document retrieval faster and more efficient. Prioritization. Focus audit efforts on high-risk areas identified through previous findings. Timeline alignment. Schedule internal reviews concurrently with external audit timelines. Common challenges faced during financial audits. One significant challenge involves reconciling different accounting methods used across various departments or subsidiaries. Inconsistent practices can create confusion during evaluations. Lack of standardized procedures often leads to incomplete records, making it difficult for auditors to form reliable conclusions. Resistance from employees accustomed to informal financial handling may hinder cooperation during investigations. Time constraints frequently force auditors to prioritize certain areas over others, potentially missing critical details. Interdepartmental coordination requires unified protocols for financial transactions and reporting. Technology integration. Modern systems facilitate real-time monitoring and automated alerts. Cultural adaptation. Training sessions help align employee behaviors with audit expectations. Evaluating auditor competency and relevance. Selecting qualified auditors depends heavily on their experience level and familiarity with relevant industries. Specialized knowledge improves audit effectiveness. Reputable auditing firms invest in continuous research to understand emerging risks facing modern businesses. This proactive approach strengthens their analytical capabilities. Verifying credentials such as CPA certification confirms an auditor's competence and commitment to ethical standards. Regular performance evaluations ensure that auditors maintain proficiency in current best practices and technological advancements. Certification checks confirm that auditors hold necessary qualifications and licenses industry expertise. Choose professionals familiar with your sector's unique challenges. Reference verifications. Review past client feedback to gauge reliability and quality of service. Post-audit procedures and continuous improvement. After completing an audit, organizations must implement corrective actions based on identified deficiencies. These steps demonstrate commitment to improvement. Creating action plans with defined timelines helps track progress toward resolving outstanding issues efficiently. Sharing audit results transparently with stakeholders fosters trust and shows accountability in governance practices. Ongoing monitoring systems allow companies to detect early signs of recurring problems rather than waiting for annual reviews. Action plan development. Translate audit recommendations into measurable objectives. Progress tracking. Utilize dashboards or reports to measure implementation success rates. Stakeholder communication. Regular updates build confidence among investors and regulators. Emerging trends shaping future audits. Digital transformation is revolutionizing traditional audit methodologies through automation tools and artificial intelligence applications. These innovations enhance both speed and precision. Blockchain technology offers immutable transaction records that simplify verification processes considerably. Its adoption promises greater transparency in financial dealings. Remote auditing capabilities enable teams to conduct evaluations without physical presence, saving time and resources associated with travel expenses. Increasing emphasis on environmental sustainability has led some organizations to incorporate ESG factors into their audit frameworks. AI analytics. Predictive modeling identifies patterns indicative of fraudulent activities. Cloud computing facilitates secure access to documents from anywhere at any time. Sustainability metrics incorporate carbon footprint analysis alongside traditional financial indicators. Conclusion. Financial audits play a pivotal role in upholding corporate responsibility and preventing misconduct within organizations. They offer structured approaches to evaluating financial health effectively. To maximize benefits from audit processes, companies should proactively engage with auditors, address weaknesses promptly, and embrace innovative technologies transforming the field continuously.